to you and welcome to On the Mark along with Mark Papa. I'm Gary Byron. Mark is with Financial Resources Group. They're located in Glastonbury, Connecticut. Of course, you can find them online at www.frplan.com. That's frplan.com. And while that's important, I want you to write down this phone number, 860-657-8380. Let me give it to you one more time. 860-657-8380. Now, the reason why I'm having you write it down, because I want you to listen to the show. I have a great show for you this morning with Mark. At the conclusion of the show, that's when I'd like you to call it. Yeah, I know it's a Saturday morning. We have our new time, and thank you for those of you who have followed us from our previous earlier time slot. And I want to welcome those who may be new to this show. Maybe the earlier time slot is just not for you, but this time slot is much better. We'll cover some things that we've already covered in past episodes because we welcome our new listeners. And hopefully it'll intrigue you enough to use the phone call. If you can't call today, call Monday morning. That would be great as well. And if you miss the phone number altogether, no worries, my friends, because I'll give it to you at least a couple of more times. Mark, good morning. Great to see you.
Hey, good morning, Gary. Thanks for letting me sleep a couple extra hours.
I like that, huh?
How are you?
I'm doing well. You're always working too. Even when you're not working, you're working.
Yeah, well, you have to stay on top of your game, Gary. And it's one of those things. Is that you get trained a certain way, and you continue to try and improve no matter what you do. Constant and never-ending improvement. I think that was oh God, who's that self-help guru there? But you're always looking to get better, always looking for a better angle,
True.
Always looking to improve. Things are changing very quickly in the world. You have to stay on top of that rapid pace. You don't want to get stale. So, yeah, I do always like to, and at some point, things do become a little bit, you get a little bit of fatigue, so you take a break and, you refresh. But, yeah, I would say that I wouldn't say I'm a total workaholic. I do have a great work-life balance.
You do like to vacate. You got to recharge the batteries.
Well, I don't really vacation more than a couple weeks a year,
Newport. That's always fun.
That's a long time, yeah. And then I might take a week here, a week there. I'm going to be traveling a little bit for business. I'm going to be at the Astoria Advisors Summit at the end of the month in October. I'll be staying in the city for a night, and we have access to a lot of amazing people. And it's for some guy, sitting in the middle of Glastonbury. What's great about this particular summit, it's John Davi at Astoria Advisors and his group of people. We're going to have the president of Wisdom Tree Investments will be there. Jim Bianco will be there. These are international names. Dr. David Kelly, who is chief economist at J.P. Morgan. We're all going to be in the same room, and it's not going to be.
Cool,
we're not going to be in the stadium here. We're talking maybe 150 people, so it's an exclusive event, and I'm lucky.
You were invited, or did you have to buy your way in? Or
you don't have to buy your way in at all. No, I'm invited. And there's going to be the knowledge that we're going to capture through that group of people is tremendous. And you're talking about the most elite people on Wall Street, so it's wonderful. Some of the best people, and I have access to them, and I can shake hands and chit chat with them and share ideas, and that's what it's all about.
That's outstanding, Mark. Before we start in getting into the subject matter of this morning, you mentioned it yourself. You get to sleep an extra couple of hours. There are we have new listeners. It's a different time slot. I'd like to think we brought most of our listeners from our previous 7:30 a.m. time slot. Here we are a couple hours later. If someone is new to the show, how would you describe this show to them?
Well, what I'm trying to do is share the things with people like we do in our business. We're sharing things that clients are unaware of. They may not have been shown by advisors. Not only this show, but my next show, we're going to definitely be talking about things that often get overlooked.
Next week, yeah.
Yeah, they get overlooked by advisors, or when advisors get complacent. If you have a good advisor who's covering everything, making sure you're not paying too much in taxes. I know they love to talk about it, but they don't do tax returns. So I actually have a tax business. I have a tax strategy business. We plan for things like taxes on your Social Security to make sure that they're as low as possible. We plan for things like the IRMA, which is the income-related monthly adjustment, so that you don't get a surcharge on your Medicare. Mm-hmm. We're planning to make sure that your RMDs are as low as possible in your retirement, maybe even eliminating them altogether so that you're not paying big tax bills during your retirement. We're looking at a lot of different things. So I'll be highlighting that in the next show. So hopefully people will tune in. And this show today is going to be about not only just about basic diversification and making a pie chart. I want to actually share one of the things, when people think about their investments in the market every day, it's NVIDIA, it's Microsoft. Okay, most recently, Oracle had a huge move to the upside. I think they signed a $300 billion deal, some insane deal. It's all about artificial intelligence, and this is what you're seeing in the market. And my NVIDIA's up. I'm a genius, and I own the S&P, and, everybody's very, very confident in the market. And what I want to highlight again is it is a time we're going to go through this interview. I don't want to give away too much up front, but we're going to go through this and talk about how the market could potentially be overvalued, how people could be overconfident. Everyone wants to jump in. And now and I want to show you that there's actually plenty of other areas other than the U.S. stock market and artificial intelligence that have actually done very, very well.
All right, so
diversification is absolutely key.
Let's get specific, Mark. What are the top asset classes shaking things up, though?
All right, so what I want to bring up this year, with tariffs and from the beginning of the year, people looked at the market and said, "Gee, it is fairly overvalued." We're going to give you some data on that. If you look at, again, 10 companies are 40% of the S&P. 9 of those 10 companies are technology stocks. 9 of those 10 companies are benefiting from this giant build out in artificial intelligence, whether it's chips, data centers, software, you name it. And that has put a major, major skew on the rest of the market. What we look to do is say, well, let's look at the other. Let's look at let's just say 490 companies in the S&P. Hopefully those are companies that have, industrials, healthcare, all sorts of different sectors will eventually adapt the AI that these 10 big companies are pushing and become more efficient, more effective, more profitable. But right now they're spending way more than they're making. It seems like just the internet build out, when they were building out the internet, it's a very similar parallel because I lived through that period too, the dot-com bubble. The difference is now is these companies are actually profitable. Okay, AI isn't net profitable, but the companies that are pushing it are net profitable. But I wanted to talk about just a huge rebalance we've seen since the beginning of the year. And everybody, again, talking about AI stocks, look at what's, if you take a look at some of the notes I left for you here, Gary, developed equities, ex-US. So these are the MSCI World Index, ex-United States, and as a result of Europe's steady recovery and then Asia's tech resilience, these have been key drivers. That index is up 24.5%. So if you just have all your money in U.S. equities or all your money in the S&P 500, while the S&P 500 may benefit from overseas growth, right? Essentially, you missed a huge move, about 24.5%. Emerging markets, let's take a look at that one. That's a close second at 24.3%. That's not a bad return, right? I mean, who's going to turn away 24%?
Not me.
And that would be emerging markets or areas like China and Brazil. I would say China's probably not so much an emerging market anymore, but, you take a look at Brazil and some of the other countries. We're going to go through the different countries that have really, really knocked it out of the park. A lot of that is tied to commodities and easing global tensions with tariffs. And I know we're still in talks with China about tariffs. I didn't want to do a show on that because I think that those talks are going to go on into perpetuity. Very little is going to get done, and it's just going to be, they're going to butt heads for forever. I think the Chinese are dug in. I don't think we're going to get very far in any negotiation with them. I think economics at the end of the day are what are going to be the overall driver.
Does Trump know that too, you think?
Probably not. Again, you can cut a deal with the Chinese, and today and tomorrow they'll walk away from the deal. I've known this. Anyone who's done business in China, it's just part of their culture. You may have a handshake, you might have a deal, but who's to say that they're even going to bother honoring it? They've been, doing things like stealing our technology, not honoring intellectual property, not actually being the honest players. But then, conversely, that same attitude scared away a lot of business and a lot of investment. So the Chinese economy, I would say, although there's Chinese stimulus that is going to be, that they're working on. I hate to say it, but China scared away a lot of growth opportunity for themselves. And they've really become tighten things up. They moved further to the left, moved further towards communism, away from free markets, and clamping down on their tech sector. There's a lot of different things that got a little scary. And I think they kind of realized, hey, we better turn this boat around quick. Otherwise, we're going to have serious problems, serious unemployment problems. They have a birth problem. There's issues there. But either way, that index did very well, emerging markets. Now, emerging markets fixed income, fancy smancy terms for bonds, people don't realize that's like, places like Singapore. You may have really high credit ratings, but emerging market bonds actually did very well, a solid 10.6% year to date. And that comes from the JP Morgan, what's the EBMI Global Diversified Index, higher yields. And then large cap U.S. equities. So the total return of the S&P 500 to date, while respectable, is about 13%. Now, historically, that's a great rate, But what I want to talk to folks about is you can't just have all your money in the U.S. It's not a bad idea. One, from a valuation perspective, you don't want nosebleed, super expensive, which I'm going to talk about in a minute. Nosebleed valuations, and what happens is when those valuations compress, you can be up 40%, but you can be down 40% pretty quickly too. God forbid we get a bust in this AI trade, or somebody comes up with a new technology.
I worry about that.
Yeah. And then the other thing I worry about is our national debt. Again, I'm going to tell this and keep harping on this. $37 trillion in debt. You have
and they're voting. They're going to keep the government running. What's that? The end of this month, September 30th.
Exactly.
We're going to have a government shutdown. No,
right.
They're going to have to kick the can down the road.
And then on top of that, Gary, the dollar is also not doing very well. It's down 10% for the year. So obviously, we're going to try and print our way out of the debt problem. But there's just a lot of issues that I'd say the debt. It really scares me when I see my son put his, we go to a game. I don't care if it's UConn, Yard Goats, Yankees, whatever, Boston Red Sox, wherever you love your sports, and you listen to the Star Spangled Banner, and you realize that we're $37 trillion in debt. It feels as if we don't even feel like we have that solid ground that America once had before, and it's very scary. So we're adding $1 trillion in debt every 173 days. So something's going to break. So I think that. We can never predict what the black swan moment is going to be, because right now it doesn't seem like there's any end in sight in what's happening. You have to prepare yourself for market volatility, whether it was tariffs. I mean, a lot of stocks are way up from those, from April. But you have to take a look and see, you need to be properly diversified, and you have to have some of your money in safe stuff. Anyone not advocating that is just out to collect their fee and make money on you. You need to have some money in safety. And if you don't have money in safety, good luck to you, because when markets correct like that, and again, they've been bouncing back a lot quicker than they have in the past due to Fed stimulus and government spending, we're going to run out of that money to spend like we did during COVID. Where's our credit card going to end?
Sounds like U.S. exceptionalism.
So you've got to protect yourself.
Yeah. I mean, it sounds like the U.S. exceptionalism narrative is kind of taking a breather. And on the index side, any standouts that investors should keep an eye on? Yeah,
I want to just touch upon commodities as well. They're up 8.3% according to the Bloomberg Commodity Index. Gold, big standout. Gold is done.
Silver as well, or just gold?
No, gold and silver. So
okay.
In our model portfolio, we have something called the Sprott Gold and Silver Index. And again, we're not here to give investment advice, so please don't act on anything that we say here. But we're not. This is not investment advice. It's for informational purposes only. But we've owned the Sprott Gold and Silver for quite some time. It usually has about a 3 to 5% allocation as an inflation hedge. We also own another ETF called PPI, which is the Astoria Inflation Hedged Index. Believe it or not, with inflation coming down, that product's actually done very, very well, just because a lot of the companies are undervalued in there. And also there was also a bias towards commodities and things like that, energy. So these stocks are way undervalued. So that's done very, very well for us. And it even did very well for us after the market crashed when the Fed, this is 2022, when the Fed was raising rates very, very aggressively. We shifted money out of our aggressive stance, which was basically the S&P 500, into the inflation hedge, and that really helped us in a down market. because we're much more conservative. And the valuations were dirt cheap. So we said, yeah, that makes a lot of sense. Let's ride out the storm with something like that. So, but yeah, so gold and commodities, I think, definitely still have some legs. And I think with the national debt, still we have some uncertainty in the world. I think people are gravitating more to gold.
Oh, yeah. Wow. Anything else in there? Or,
Well, what I also want to bring up is, so this is why it's so important that you want to have exposure. Now when we say exposure, when we build I would say our model is about, somewhere it ranges from 60 to 70%, sometimes U.S. But lately, I plan on doing a greater shift to the bigger global picture, being that the United States is so expensive. But bottom line here, Gary, is how many people knew that Greece of all places, remember what was going on with Greece not so long ago? Do you remember where they were having trouble?
They were going to go bankrupt.
They were going to go bankrupt. They're leaving the EU.
Yeah.
That was going to cause all sorts of problems with the world, and the EU was going to unravel now that Greece was leaving, and blah, blah, blah. Greece saw an increase of 48.7% based on EU reforms and economic tailwinds at play. So, I don't know anybody out there who said, hey, let's pound in the table. Let's buy Greece at the beginning of the year. So this is why, again, you have to diversify, because you can't pick when these things are going to pop, right? Again, if you're like a genius hedge fund guy and you're one of the 1% of the 1%, and you know when to buy this stuff, but anyone who claims that to do that, there's only, their minimums are probably $50 million. So, you're not seeing that. But then you look at the FTSE FTSE, Vietnam was up 39.32%. That was also fueled by manufacturing surges and other foreign domestic investments that were coming in flows. Now Spain, we've been hearing a lot of trouble there. The tourism is booming in Spain, but it's also causing problems, right? I don't know if you saw the news. I've seen the news where the locals are just getting really nasty with the tourists because they're taking over the country.
Tourists are taking over the country.
Well, there's a big tourism. I mean, I know a lot of people that go to Barcelona and they want to go to the
Greek islands too.
Yeah, the Catalan region of Spain. So tourism and energy rebounding. So that was up 36%. So how many people bought these sector? Were buying these things? I would say a lot of people were probably missing out on these. Again, if your advisor's pushing, hey, the S&P is the way to go, and I can tell you that a lot of portfolios we work on have a huge bias towards the S&P 500.
Let me just interrupt you for a brief moment. Folks, you are listening to On the Mark, along with Mark Papa. I'm Gary Byron. You can find out more about Financial Resources Group, which is Mark is with, frplan.com, www.frplan.com, and 860-657-8380. I will repeat those points of contact more towards the end of the show, as well as give you some info on how you can obtain a $100 gift card from Mark Papa and Financial Resources Group. Please continue, Mark.
All right, Gary. Let me just go down the list here. We had Korea also. Korea was up 36.5%. Poland, friends, Poland, a great ally of the United States, up 35.94%. The South Africans, they were up 31% approximately. Italy, of all places, who would think that Italy would bounce so much? 30.18. Austria, 29.29, and then Mexico up 27.59. So even with all the tariff talks and all the media, talking about how they're going to, we're going to have all this inflation from tariffs. We haven't seen any of that yet, by the way. But that all these countries were, well, let me tell you what I think is going to happen with that, by the way. So with the tariffs, we have not seen the inflation work its way into the economy yet. I will say that what's going to happen, we have to take a look and see between now and Christmas, as we burn off all those inventories that were front-loaded into the end of the year before the tariffs were going to take effect. I wanted to talk about that, and I think that's when we could see some of those tariffs kick in. But I also, dear Gary, I want to talk about, remember I talked about the valuation of the market.
Yeah, you talked about U.S. valuations, the S&P 500 and NASDAQ. They posted some solid returns, yet there's actually chatter about what Roth What's the read on metrics like PE ratios and really how does concentration play into that overvaluation vibe?
Well, here's the problem. Because of the concentration, those Mag 7 companies are trading at such significantly high multiples due to the growth of AI. It's skewing the rest of the market. So it's making companies that are trading at 14 times earnings look expensive. That company, what's happening is when you go down the food chain, because they are such a big part of the S&P, if 10 stocks make up 40%, and those, they're trading at a very high multiple, it's going to make the entire index look expensive. But there's companies underneath those 10, the bottom 490, that aren't so expensive, where there's some great opportunities. So that's what we've been hunting. That's what we're looking for. So we like a more equally weighted approach. And equally weighted versus market cap weighted means we don't have, the biggest companies get the biggest share of the pie. And equally weighted would mean NVIDIA would have the same weighting as, let's say, CBS, right? Or the same weighting as, JP Morgan. JP Morgan's obviously huge, but so you want the big companies, you want to have equal weighting among the smaller companies also. When you have a cap weighted market, that means that, 40% of your money is going to be in 10 stocks, which is great on the upside, but, the downside could be pretty bad. So let me talk about price to earnings ratio. Simple terms, it's price divided by earnings. It's a very simple way to measure the value of a company. So if a company is growing at, trading at 40 times earnings, but earnings are growing at 50 times, then it's undervalued. If earnings are only growing at 20 times and it's trading at 40 times earnings, that means it's way overvalued, twice what its earnings growth are. So you have to look at the forward-looking PE and you have to look at the backward historical PE. So let's take a look here. Let's look at some of the numbers up to as of September 16th. The trailing price to earnings for the S&P, this is the backward-looking number, is about 30 times. Okay. Mm-hmm. It's way above, though, the 15 to 20 times historical norms. That's 30 times earnings versus 15 to 20 times. That is way, way above the norm. And then the forward PE, just forward looking out 12 months, assuming that we get the earnings growth to meet that number, is 25 times. And the NASDAQ, so 25 times earnings, which is high. It's still way above the historical norm. And then you have the NASDAQ trading at 32.7 times versus, and then the forward of 28, which is way above its average. So does that tell you, if we're way above average on our valuations, does that tell us the market's cheap right now, or is it pretty expensive?
Yeah.
All right. Is Warren Buffett pulling the trigger and buying stuff, or is Warren Buffett waiting for a correction? And I would say with these numbers, he's waiting for a correction. So I want to talk about some other indexes that we like to follow too, just to measure and gauge why this market's overvalued. And I want to stress to the listeners why you need to be smart and not bail out of the market, but be cognizant of making sure you have some safe money so that if this market does tank, you can pull your money from the safe bucket versus pulling it from the bucket that's going to be down. Okay? Mm-hmm. Have the confidence to balance out your portfolio is what we do. We balance people out so that they can stay in the market regardless of what the market's going to do. Okay? We've heard too many horror stories. Hey, the market was down 20%. Everyone bailed out in April. They did not get back in, and the market skyrocketed. That's a huge, what they call, economies call opportunity cost, and those losses are locked in forever. And, you're living on a lot less. So that's not the way to play the game. So that's why dealing with a professional, we can help you figure that out. But there's another thing called the Shiller PE. Shiller is a Yale professor, or the CAPE. And that right now is way above norm, 39.78. When it hits those territories, the long-term average is 16.9. So again, that's more than double. And that's 44% over its 20-year mean of 20.7. So I'm throwing a lot of numbers out here, but here's the bottom line. Those are levels echoing the 2000 dot-com peak at 44 times. And so we're looking at some pretty serious valuations. And like I said, it's important to go to my website, www.frplan.com. We're not here to scare you in any way, but we're here to bring you back to reality, bring your retirement into sanity, bring your retirement into...
What does the Buffett indicator tell you?
The Buffett indicator, well, again, that's probably why he's not buying. The Buffett indicator is the total U.S. market cap to GDP GDP is the growth domestic product. So that's, all the goods and services in simple terms, are the size of our economy. There's GNP and GDP, but just in simple terms, that's at 217.6%, a record high. That's higher than where it was in the 2000s. So when we ask ourselves what happened in 2000 with the dot-com bubble, Gary, it was ugly, right? We saw the NASDAQ lost 75% of its value, and it was a slow drip. It was ugly, sharp and ugly, and then it was just a slow drip. So we saw, stocks that were trading in the, $200-$300 a share go down to $1. And I remember that. So, we've got to be smart about this. And that's why I'm saying people need to contact me.
As far as the skew is concerned, are you just blaming the Magnificent Seven? I only have about a minute and a half.
I think it's very easy to blame the Magnificent Seven, with the exception of Apple that has actually, imagine this, Apple's not even, I think it's down to flat for the year. But it's, the Apple, Microsoft, NVIDIA, those three are now 34% of the weight. And that was 20% in 2023. So look at that difference right there. Those three companies are now 34% of the market, S&P market, when they were only 20% in 2023. They've powered 75% of all the gains since then on AI hype. And they're trading at, 40 times earnings, which is a huge price to earnings. I mean, that's ridiculous. And so we've got to be smart about this. We need to have our diversification. I would say shift. Again, see me. Our model portfolio does have money in overseas assets. We have money in a little bit of India because I think long term they're growing very well. I know we've had some trouble with the tariffs. We have money in what's called the hedged.
Well, they're cozying up to China and Russia as well.
So. They're buying oil from them. I think that's a very nice thing.
I got to wrap this up. You got about 10 seconds here, right?
Well, I think the best thing to do, have us review your portfolio. We can stress test it with Morningstar and some of the other software we have. You need to be diversified, and most of you think you are. You're not. I'll prove it to you.
How do they get a $100 gift card from you?
Come in, sit down with me. I'll tell you what to bring. We'll perform a full checklist. We're going to look for benefits you're owed that you're not aware of. We're going to look at your home insurance. We're going to look at your legal docs. We're going to make sure your power of attorney is working correctly with your bank, Social Security, and the government agencies. And I'll actually pay you to bring those things in.
Look at that. Head on over to frplan.com, F as in Frank, frplan.com, and call this number right now, 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Mark Papa. Until next weekend, have a good one, everybody. So long.